Hi, Michael Glennon from Glennon Capital, and today I'm going to talk to you about Telstra. It's not something we invest in because we don't do small caps, but it's an interesting business to look at for a case study on how businesses work. So we've never liked Telstra. It's not a type of business that I would generally invest in. And the reason I don't like Telstra is that it's got to keep reinventing its business every couple of years. So what I mean by that is if you take the individual products that Telstra sells and you group them together, and you say that one of those groups of products is fixed line. So there's many different types of fixed line rental that Telstra offers. But if you look at the characteristics of fixed line, that was the only way you could access making telephone calls many years ago. So that was a stable component of Telstra's income. And then all of a sudden, there's the invention of the mobile phone, and so mobile phones start to take off. So what that means is that the fixed line becomes a mature business, and then over time that starts to decline. So about 2005, fixed line phone rental peaked for Telstra, and it's been in decline since that period of time. However, what's happened in entirety for Telstra is that their revenue has stayed at about $25 billion over the past 10 years. So what that means is products are declining, they have to start to find new products or groups of products where they're growing to offset what's happening in the declining part of their business. So as fixed line declined, we started to see this product lifestyle of mobile phones where the early adopters and then the mass market starts to get into that product and it starts to decline. And over the last couple of years, we've seen mobile phones start to decline as part of Telstra's overall revenue. But what Telstra was able to do then is replace that with broadband and internet services. So that's now their growth product. So it's in that growth phase still, and people are consuming more and more data. Now the problem with that as a business, in total we've got these products that increase then decrease. You've got to keep finding new businesses and completely reinvent your business every couple of years. So that's one of the reasons we don't like Telstra. And how that translates through into Telstra's results is revenue has stayed around that $25 billion mark for the last few years. Earnings per share has actually increased reasonably well over the last few years, but because the business is actually having to reinvent all of these new products with new infrastructure over a couple of years, what we've seen with Telstra is that earnings per share has stayed reasonably flat over that 10-year period because they've been spending money on infrastructure to support the new businesses. And so overall, cash flow per share has decreased while earnings per share has increased because they're building up this larger asset base to start to generate more revenue or maintain the existing revenue that they've got. So it's not a great investment. It's not something that we like. It pays out a lot of its profit in terms of dividends. I don't think that's maintainable going forward. I think they'll have good growth out of data in years to come, but I think it's going to only offset the declines in both mobile and in fixed line rental. So thanks for watching. It's one of the businesses we don't like, and keep watching our videos and look at us on Facebook or YouTube if you want to find out more. Thank you.